to call this meeting of the Budget Committee to order. Have Mr. Lockyer come forward. Just want to set the context of this hearing. We're going to hear three different agenda items, three different issues. This is sort of a precursor. This will be the last hearing before we get to the. We'll actually have the May revise in front of us, and we'll be dealing with specific numbers and dealing with the subcommittee process and the details. But there's a couple of issues that are important, and this hearing is going to give us a chance to vet some of those. One, and we're very privileged to have with us the state treasurer here, and he's going to talk with us about some of our credit issues. And to me, this is one of those issues. We're paying a tremendous amount in interest payment, and we all, that's one of the fastest growing sections of our budget, and it's one that nobody likes to pay because it doesn't provide services, it doesn't give money back to the taxpayers. Obviously, it's something we have to pay, but the question is, are we paying the right amount, and is this happening? Is our interest payments fair and reflective of what we're getting out of them? To me, it's particularly we've been reading all these articles lately about credit swaps and potential double dealing and all sorts of things. And I've always been stumped. I mean, the fact that when we're rated as a state, we're rated just like a corporation, except for the fact that they don't consider our default rate. We've never defaulted once, and yet that comes up as something where we don't get credit for that as sort of to get a AAA rating. Another thing is our debt to asset ratio. I've never heard an actual list of what the assets of the state of California are. But when you consider the bond rating for a company, the debt to asset ratio is always one of the critical factors. So I frankly think we're as a state we're getting jerked around, frankly, by folks on Wall Street, and I think it's not going to be easy to stop that. But the first way to stop it is to get a little bit more of an awareness about it. Mr. Lockyer has some ideas of how we can go about stopping that. But the reality is, and this crosses all ideology. When the state of California is having its chain jerked, and our interest payments are not reflective of what the actual creditworthiness of the state is, it's hurting all of us. There's a lot of inequity in terms of we're not getting our fair interest rate, and frankly there might be some iniquity because some of the very same companies that are determining that are selling our bond rate are also out there selling credit swaps that they're profiting on the fact that they're able to drive down the creditworthiness of the state of California. And that's something I think we can all really get behind. So that's going to be topic number one for this hearing. Topics 2 and 3 will kind of lump together. Topic 2 has to do with some of the recent changes that we've done in business tax over the last couple of years. Single sales factor, looking at that, having the LAO look at why did we do those in the future? Do we need to continue those? Are there ways? Should we move to a mandatory single sales factor? And just getting some ideas about the effectiveness of those that we've done. And then the third one is what I think is looking at this budget in its totality. It sort of irks me that oftentimes we just talk about the budget as an $85 billion budget. Well, it's not an $85 billion budget. It's a $135 billion budget. The difference, the $50 billion difference, is tax credits and tax deductions, some of which are very worthy and I'm 100% supportive of. But I think we need to have the dialogue when we're talking about shared sacrifice and we're talking about the fact that we don't have the revenues anymore to sustain all of our spending, that we need to talk about all of our spending. And all of our spending includes taxes, includes tax deductions, tax credits, and program expenditures. So I'd like for us to have a dialogue about the totality of it, look at the shared sacrifice, and see if maybe by doing that we may be able to come to a greater consensus on how we go about moving forward with a budget. So Items 2 and 3, we'll have the LAO up here, and we'll talk about those. And we'll ask the treasurer to focus on item 1, but of course he's free to comment on any of the items he wishes to. And we're very pleased and honored by your presence, Mr. Treasurer, and I'd like to turn the mic over to you for your statements.
Thank you very much, Mr. Chairman. Members, let me start by asking if the microphone's on.
And actually, since your button's off, before we get started, we have a quorum. Might I indulge you if we could call the roll and take care of the housekeeping business?
Blumenfield,
Present.
Nielsen, Adams, Arambula, Bell, No. Brownlee, Berryhill, Buchanan, Caballero, Carter, Chesbro, Cook,
Here.
De La Torre, Emerson, Evans, Pure, Fuller, Bertani, Gilmore, Harkey, Huffman, Jeffries, Jones, Nestandi, Ruskin, Silva, Swanson.
Present.
Thank you. Mr. Lockyer.
Mr. Chairman, let me just initially bring your attention, if I may, just quickly to the handout, because it does, I hope, provide answers to some of the questions we regularly get asked. And it's essentially, how much debt is still outstanding, what's been authorized for what purposes. If you looked at page 2, you can probably get a sense of what hasn't yet been sold in terms of some possible planning for where specific accounts are likely to be exhausted someday, and there'll be a need to think ahead in order to provide future authorizations if people are so inclined. And so note that there's still 3 times the amount in the pool for transportation projects compared to education projects. It might be worth mentioning that the State Allocation Board has authorized about $1.3 billion in education project spending that's still not being done by local agencies. We don't control whether they do it or not, but I note just simply the voters have authorized them. The allocation mechanisms have concluded, and it's reticence or delays at the local level that are impeding the projects from going forward in most instances. So that may give you a sense of what the timing ought to be if people are going to consider future bond authorizations. I know you asked mostly to comment on the California credit as an issuer. In fact, the largest issuer in the country last year was the state of California in both the municipal and the corporate markets. Last year was not a year when corporations were going to market with a lot of debt. To the extent that they were active in those ways, it seemed to be the federal government was picking up the debt, not the private markets. And there wasn't a lot of merger and acquisition activity, which is frequently fueled by debt issuance. We usually are, in recent years, the largest municipal issuer after us, the state of New York, and then sprinkled around the country. So far this year, we've issued just barely under $6 billion in, we've sold $6 billion California GO bonds. We expect, if markets are hospitable, if a budget is adopted in a reasonable amount of time that gives us an opportunity to go to market twice in the fall, that there will be probably about $8 billion more of the previously authorized bonds that we'll go to market with for the variety of things, transportation, levies, schools, and so on. I've been, I guess, a bit of a crusader with respect to the rating agencies. These are the firms that you're familiar with, Standard & Poor's, Fitch, Moody's, that rate debt, both public and private debt. It seems like just historically, the way their system evolved, they began, they didn't rank corporate and municipal and public debt at the same time with the same analytical framework. They grew independently, and so the result of that, I think, has been a fundamental unfairness. If what a investor wants to know when they buy a bond, particularly the small investor, not the sophisticated money fund or something of that nature, but people that make modest investments in bonds because of the yield, tax-free, and security associated with them, they read the letters, A, AAA, B+, whatever those scales may be. And it seemed terribly unfair that if you look at the corporate scale and compare it to the municipal debt scale, the likelihood of the bond going bad, the likelihood of default by the issuer of the bond is significantly higher in the corporate world than in the municipal world. And yet we get ranked lower. It doesn't make any sense. It's a discrimination that's built into their rating system that seems to me to be terribly unfair. When you ask the rating agencies, as I have numerous times during the last 3 years or so, what's the basis for this? Explain your mechanisms to do evaluations. Mostly they will say it's proprietary, and so they don't make it public. Once in a while, when they explain it, the explanations from one week to another week are different of what the factors are and how they weigh them, and it's kind of a puzzle, frankly. And so as a consequence, me and a lot of other public debt issuers, other states, the National Treasurers Association, various kinds of financial services groups that are associated with public issues, have been pushing them to try to get them to recalibrate and to have some logical connection between the way they analyze default on the corporate side or potential default on the public side. And they've begun to do that. Moody's and Fitch have begun that process of recalibration. The result has been improvements in our ratings. So we were essentially a year ago or 6 months ago, they all have slightly different ways they describe the letters they use and so on, but essentially in the high B categories, and we've gone up 3 rungs, about two rungs above junk bond status, where we were. We've gone up 3 rungs on Moody's, 2 on Fitch, nothing on Standard & Poor. I call them Poor Standard. Poor Standard has claimed all along that they don't have a unified scale and that they don't discriminate in their ratings. It's totally illogical. It makes no sense. It's an indefensible position, but it's their view. And they periodically just internally upgrade a bundle of debt instruments, and it seems to be that's how they're dealing with it rather than admitting that they have a system that's discriminatory. In terms of remedies other than jawboning and, just, I think we kind of got them at a good time because they had, as you'll recall, just a couple of years ago, decided that all of the exotic derivatives, something like 2,639 sieves, and those other synthetics that we've read a lot about in the market that all went bad, they were all basically ranked as AAA, as high a rating as you can get, while California would be A or A minus or whatever. You know, we're not defaulting. We never have. There are various guarantees about payment of debt, the constitutional guarantees, a contract, and so on. But also the fact is, for payment of debt, we have a continuous appropriation. So while I certainly don't wish that the legislature failed to adopt a budget, if you didn't have a budget, we would still pay debt service anyhow, because it's in effect exempt from the budget process because we have a continuous appropriation to pay debt service. It's a good protection. It's one of the things we can say to people that want to buy California bonds because they see the optics of the budget fight every summer, and the fact that we're, of course, one of 3 states that require 2/3 vote to adopt a budget, so we typically have difficulties getting the 2/3 together. They see that and wonder if that somehow means our credit is less worthwhile than states that adopt a budget in a more timely way. And the budget optics of the summer, I think, cost taxpayers, it's hard to calculate a number, but tens of millions of dollars, because we're paying more for debt. We're paying more for our bond issuances because of those summer fights. There's no easy solution to that, but you know, I note it because it isn't just the rating agencies and their discriminatory behavior that causes us to pay more for our debt. And maybe in one other way I should mention, Mr. Chairman, before responding to any questions or comments. We're essentially, the basic fundamental infrastructure of California were laid down a half a century ago when the university system, the freeway system, the water system, and so on were developed and paid for. But it was a system designed to carry about 25 million people, and we're approaching 40 million. And so partly what's been happening in the last several years is trying to catch up so that commerce is not impeded by the lack of adequate transportation facilities, that agricultural interests and property and persons are protected from flood by levee investments and so on. So we've been kind of catching up, and that's part of the reason there's been this growth in debt in the last decade or so. While state revenues have gone up 22%, my recollection is the debt provision in the general fund is increased 144%. Now, it's from a small base, but it's a sign of a debt growth that we should be sensitive to and understand that debt payment competes with other general fund expenditures. Thank you, Mr. Chairman. Happy to respond if there are questions.
Great. A couple of quick questions, and I'll bring it up to the members too. Debt to asset ratio, is that ever considered, and how can we get that considered? Our assets being all of our parks, all of our buildings, all of our everything that the California is pretty wealthy, and I know that that's part of what corporations are based on.
Good morning, Blake Fowler with the State Treasurer's Office. Debt to asset ratio is not typically a metric that investors or rating agencies look at for states and municipalities. More common ratio would be looking at our general fund debt service to our general fund revenues. Also debt per capita. Those are the most common metrics.
Right. Oh, and yet but it is commonly one of the major inputs for corporate ratings, of which we're often compared to.
I would step down, I think.
Yes, it just isn't one of the they've, with sovereign debt, they, have just different indices, and as Blake had mentioned, I guess partly reflecting the fact that we don't contemporize asset values in any reliable and regular way. So it might be a lot of work that doesn't get you anywhere.
Okay. You wrote to the underwriters of some of our bonds about their involvement with the credit default swaps.
Yes.
And particularly the ones that you thought were betting against the state, and that's when I was referring to earlier inequities and iniquities. Have they responded, or what is the status of that?
They've responded, and we wrote additional letters asking for additional information. But essentially, what the major investment banks, this is Citi, Morgan, the half a dozen large Wall Street, Goldman Sachs and so on, the large Wall Street firms that we do a lot of business with. Now, I've made a special effort to involve, I should mention, California firms in the issuing deals so that we would try to help build that industry in the state of California and not just rely on Wall Street to do all of the work. And they've grown substantially in the last few years with their share of California debt issuance. But what we asked essentially was the question you posed, Mr. Chairman, which is, are you selling bonds we're your client, you're selling our bonds, are you also going to the market and telling investors, you ought to worry about it and buy insurance, called credit default swaps? Or should you buy insurance against the California bonds that they're selling for us? And that seems to be kind of fork-tongue speech that, at least in theory, could make the bond more expensive for us because there's this doubt created in the marketplace by the same firm. Well, it turns out it's complicated. There are different, there are clients, many clients want it, so they're just providing what their clients say they want from them. We asked, are they doing it on their own account? We asked a lot of things, but one of them was, are you doing it on where you trade and you keep our bonds in your own account, and then you're doing that as well? Is it hedging, or are you naked? That is, are you just out shorting California paper and encouraging that to happen, betting that it's going to go down in value? And it turns out that the market for California swaps, by the way, I learned just an interesting aside, which is AIG had a bunch of them that the Federal Reserve picked up when they took over AIG. Not that they wanted those, but they're now, our credit default swaps for California are held by the federal government, among others. But it's a thin market. There's not much going on there. There's sophisticated investors that want to do it. And so it doesn't appear that there's any evidence of an impact on the price of our bonds or market manipulation that should be actionable in some way. Now we're going back again and asking for additional information, particularly to figure out to what extent people are speculating in these insurance products, not buying a California bond, but just speculating on whether we're going to go down. And we want to find that out, and then maybe I can give you a fuller answer when we learn that.
Because if there is that kind of speculation, that could sort of be creating a self-fulfilling prophecy, driving us cyclically down.
There's no evidence that there's sufficient volume to have that effect. It's disturbing if a company does that, that's for whom you're a client, but it doesn't seem to be happening in a way that affects the prices of our bonds. But we're getting more microscopic in our review of what's going on, and I hope to get more information before the end of the month from those big firms. They're not terribly enthusiastic about coming forward with more information. There's a lot of disclaimers from lawyers and other things you get whenever they provide it. I was called recently by one of the firms that said, well, we thought this was sort of intellectual curiosity, and it's feeling more and more like an investigation. And I said, well, you know, we want some information. I don't know what it results in, but at least help us get the information. So, Mr. Chairman, if I may, I meant to mention this earlier, if I could, because it's sort of fashionable to do the California and Greece apocalyptic stories that we hear, and maybe it's worth mentioning the numbers just very quickly. The debt payments in Greece as a percentage of their GDP are their budget deficits are about 13% of their GDP. Ours is 1% or a little bit less than 1% of the California GDP. The G7, the 7 largest economies, we would be G8 if we were a country. The 7 largest aggregate debt is 112% of their GDP. 112%. Japan is 212%. Greece is about 115. The federal government is probably 85, 90% of GDP. We're 4% of the state's GDP. So as a sovereign entity, our debt is modest, compared at least to other sovereign issuers. Now, I don't know what the right amount is, but I mean it's just relative to others, where the capacity to invest in infrastructure by bond issues is still rather substantial.
Have you calculated, with as much as we're underrated in terms of our credit rating, how much that has cost us in the last several years?
Guess at a number?
In the handout we've provided on slide 6, it gives you an example of the cost differential between what we are paying on our bonds and a AAA rated bond, and what that differential would be if you applied it to all of our authorized but unissued bonds.
So have you done a cumulative number?
233.
233 million, okay.
That's with what has not yet gone out the door. So in terms of what's debt service currently, have we ever done that calculation?
No, we have not.
Yeah.
Last very quick question, then we'll move on to the member questions, which is California Forward Initiative. Do you think that would, moving that forward would help or hurt, or how would it impact our credit rating? Mr. Fury, you have an additional?
Well, I think...
Can I actually, can I set that up a little bit for a moment?
Certainly. As the author of the California Forward proposal, please go ahead and...
Well, here's what I wanted to say about that, because my one question actually was going to be this one. The Treasurer issued a report that analyzed rating agencies' concerns about the structure of California government. And among the elements in the Treasurer's report was, as the Treasurer's noted, the fact that California has this unfortunately fairly unique status of requiring a 2/3 vote of the legislature to balance the budget, to adopt a budget, and the Treasurer referred to that. But the report also referred to other elements of our governing structure. The report said that the rating agencies don't like how our ballot initiatives tie up money that otherwise the state legislature would have discretion over. The report noted that one-time revenue windfalls are often applied to ongoing expenditures in California. The report noted that our revenue forecasts in California are revised less frequently than in other states, and so we don't get frequent snapshots of where we stand. So having reviewed that report, all I was going to say, Mr. Chair, is I was curious, too, as to whether a reform package that responded to those concerns could, in fact, lessen our interest payments by improving our bond ratings, since these are the concerns that the rating agencies have noted. And if those interest rates went down, of course, we'd have more money for education, health care, public safety, or to return to taxpayers. So thank you, Mr. Chair, for that deference, but I wanted to correlate the
Please know
report
that-
to the reform agenda.
Yeah, some of those suggestions are probably ones about which there would be bipartisan agreement that they were sensible reforms. And some would obviously be philosophically objectionable to some. It's very hard to calculate the market impact of a bundle of changes like that, but I'm assuming, first of all, you know, it's been 14 years since we had an old-fashioned balanced budget in California. If we everybody knows that. The pessimism in the marketplace, the opinion leaders, I go to a national treasurers conference, and they laugh about us and IOUs. I mean, to the point where I'm not sure I want to go anymore because they make fun of me. And I don't have anything to do with it, but, you know, other than to redeem them as the bank. But so there's just an attitude about California that we're mismanaged, we're badly governed, that we can't get our act together. And so to the extent that we do things like you did in the spring when you enacted the cash management proposal to allow us to avoid issuing IOUs, hopefully, this summer, that had a very positive impact on rating agencies and others that look at California and want to see signs of governance improvements. So there's a bundle, you know, performance budgeting, so the things you mentioned about forecasts that are more current and so on. Those would probably be good things to do. The summer fight is what creates the national headlines that affects the market, and I don't see a way to avoid that in the current environment. But, you know, the other two states, Arkansas and Rhode Island, have more than 2/3 in one party. So they argue with each other, but they don't have the same breadth of argument that we have in California. But I'm assuming it would make a difference. I think most experts think some of those, if it looks like California is solving its problems, enacting balanced budgets, and I can't say enough how badly I think we need to have balanced budgets. That just needs to get done. But I think it'll make a difference in our debt obligations and what we can sell bonds for, and what the money's then usable for other purposes.
Okay, Ms. Harkey, followed by Mr. Swanson.
Thank you for coming to speak to us. First, I just wanted to comment on the ratios that we would use in the state. I think the reason, Chair, that we wouldn't use the debt to asset for a state is because our assets aren't really liquid. You know, how do you derive, are you going to really sell off your state parks? Some of the buildings maybe, but real estate they're public assets. So they're not really valued at what the market would bear, were they not held in public trust. Water, gas, oil, whatever we had on those lands would surely be able to be collateralized in some form, but that would be the only reason you'd use that debt to equity or debt to asset kind of ratio, is if you thought that there was some place you could collateralize it and actually repay your debt. And I think that's why it's not used for public entities. We used to have, as you heard, the debt to revenue ratio, which is very important, and it used to be under 6%. That's kind of a standard to keep it under 6%. But the treasurer, very knowingly, when I first got elected, I was trying to establish it because I saw it going up immediately. I was looking at our financials and realized the conundrum we were in debt, as well as our expenses. Matter of fact, I declared that we were fundamentally bankrupt, Had we been able to declare it, we probably would have been a company. So I was trying to do a debt to revenue of not more than 8%. But we had a discussion, and the treasurer already knew that based on the acts of the legislature and the governor, that in fact we were going to blow through that, which we will and we have.
Haven't
So
yet, but
we have.
potentially can. Haven't
Right,
yet,
we
but
haven't yet, but we're getting there.
Yeah.
We're getting there real
We're still
quick.
a little under 6.
So anyway, that being said, I think the LAO did a report that stated that we were at 12% between debt and pensions, and we'd be over 15% by 2015. And I think pension was 5, debt was 10. Part of the problem, we're being compared with Greece, and I agree, we're not Greece. We're not Greece. We are sovereign. We can't print money, but we are sovereign. And our ratios are not Greece-like, but everybody likes to throw mud at California, and surely a lot of it is deserved. We haven't handled our finances well. But we can compare ourselves very much to the New York City guarantee of debt. 1995, the state of California actually issued a report. I can provide it to any members who'd like to see it, and the comparisons are just tracking right on with. There is a potential, I believe, for the federal government to help us out and guarantee some of our debt in the future, which I would not like to see. And that's why I would hope that this body could really strengthen its position and get things in order so that we don't have to go that route, because you don't want to be sitting in an elected position or even a governor position and lose your sovereignty, in essence, to the federal government, which is what could happen. So that's what happened in New York City, and that could happen to us. And I did that comparison. With regard to what we're spending, I'm glad to see this. We can see that we are spending quite a bit more for our rating, and the agencies really look at the bond holders, the debt holders, look at how they want to be sure they're going to get paid off. Mm-hmm. And the way that we're structured right now, they know that we're going to pay them off. However, there is a risk of variety of things, because we're just we're going to have $20 billion deficits for the next 5 years in our general fund. And so how we deal with those issues, the bondholders will get paid off, but we have other obligations we need to meet, very much other obligations, as you all know. So I think I have looked at a variety of remedies to help us get on a track that would be legislatively driven rather than federal government driven, and I'd like to go through those, but you can surely see on page 6 the amount of the dollars. You can also see on page 7, and this has been provided to this body before, mm-hmm. the comparison of where we are with these other nations, which are not necessarily first-tier nations. So I think we can do better, and I always appreciate when we get these reports from the treasurer, because he's kind of giving us a big warning without saying so. His job is to fund the debt that this legislature determines to let, but I think we are maxed out in my. Yeah, we need to really pull back here.
Assemblywoman, the good news on that last chart is we used to be below all those third world countries, and because of the recalibrations, we've actually gone ahead of them, so that's the good news.
You have managed to keep us in the markets and keep us borrowing, but it's up to the legislature and the governor to say when we've reached that cap, and we have met that cap based on our rating. We're really, when you're going out to market, sir, asking for buy California bonds versus selling them, letting investment banks just do the wholesale, I mean, it's kind of saying something that, you know, we can't market a huge quantity anymore. We're going to get bits and pieces, and we're going to be paying dearly for it. And I think these are decisions we really have to make here. We've authorized $50 billion in bonds since 2004 in this House and sent them down to the voters, and the voters have approved them because they're for transportation, education, water, and public safety. And they will approve those issues every time they're sent down to them. So I think we need to be a little more careful from this side as to what we do. Thank you.
Mr. Swanson, followed by Ms. Buchanan, and I'm just going to say to all members to try to, because I realize timing-wise, we're probably not going to have time to do all of the different issues. We may just be able to handle this one, so I'd ask members to try to be as concise as possible, but this is an important topic, and I don't want to limit anyone's conversation on it. So,
Okay.
Mr. Swanson,
Thank you.
followed by Ms. Buchanan.
Treasurer Locker, thank you so much. I have two questions for you to comment on. First, do you anticipate the timing of our budget decisions? How important is the timing of our budget decisions to our future bond ratings, and are we on track as you see it, or should we be thinking in that in terms of the importance of timing as it was in the past? And then I have a follow-up question.
We need, we normally issue short-term revenue notes to just meet the cash flow needs within the fiscal year. This summer, we anticipate that we need about $10 billion. Those numbers get refined during the course of the cash flow analysis, but it looks like about $10 billion, and I'd wait for finance and the controller's office to indicate when we start running into the red and need to have those notes sold. And that's essentially because the big revenue months are April, not this April, but normally April, and the end of the year, holidays. And so the troughs we finance to smooth out the financing needs. We used to be able to borrow internally more, but over the last several years, there's been so much internal borrowing against other accounts that we have to go to the market more than we used to be able to do internally. So $10 billion, perhaps by August. Otherwise, we start substantially deferring on payments. 3/4 of the state budget is transfers to local agencies of one sort or another, and then the bills that get paid, Medi-Cal, and so on. Well, if we can't get the RAND financing put together, and we need some weeks ahead of time to do it, so that budget delay impacts that. Then we need to get out in the fall to finance the infrastructure projects, maybe $8 billion. Probably have to go twice. And there's a blackout period when you can't make adequate disclosures to investors because the governor's office is still putting the budget together and the forecasts and so on. And so we start running into that blackout period if the delay is substantial in the summer. So
it seems like the solutions that we will talk about in terms of our budget with this $19 or $20 billion solution, you would advise us to actually do that sooner than later.
Sooner the better.
Because it would create an environment of stability. And certainly we would want those fixes to be real so that we wouldn't find ourselves in an emergency situation in the fall, which could, in fact, affect the bond ratings. Is that right?
Yes.
And my second question is on the debt ratio, on the debt service. Our current debt service is what percentage?
It's 5.2?
About 5.
Just about $5 billion of general fund money.
$5 billion of general fund.
So when we talk about a percentage, we always talk about a percentage of general fund revenues. And so if the general fund fluctuates, obviously that produces a different result in terms of what percent of the general fund that is. And so, but right now it's a little under 6%.
And debt service, are there, debt service is a very specific item. So are there some creative ways that we ought to be considering addressing that question, debt service, that we could even pose to the people of California where we try to figure out how we target debt service as an objective, and that we can explain that this is what we're doing with this to try to bring California's budget under control. Are there any creative thoughts that you may have about that, or other states have tried that you can think of at this point? If not, please share it with us later. But just throw that out for your consideration.
No, other than we try to refinance when, as like in the current market, just like you might refinance a home mortgage because the interest rates are lower now than they maybe were 5 years ago. And so we do that regularly as part of our bond work to just get better deals with lower debt service. But other than that, Assemblyman, I'm not sure there's anything else to recommend.
Thank you very much.
I would just comment that the state has been a big user of the new Build America Bonds program. We've issued over $10 billion of Build America bonds, and we estimate that those bonds, compared to if we would have issued on a tax-exempt basis, would save us about $2.4 billion over a 30-year period.
So there may be some financial, marginally, some financial relief how we do it.
Yeah, I should have mentioned that earlier, that we have this new flavor of bonds authorized by the federal stimulus laws, where the federal government subsidizes the interest rate, 35% of it. So, in effect, we're getting back some of our money we send to Washington in that manner. And the interest rate on those, they're taxable bonds, so they're more like a corporate bond that's taxable than the tax-exempt that we've always relied on. It's a deeper and broader pool of investors. So when we were in the market this 2 months ago, with a Build America bond, taxable bond, we were selling for the first time in Japan, Switzerland, Saudi Arabia, because they don't have a tax-exempt reason to buy the traditional bond, but our rates are such that they would buy those, and a lot of investors looking for safe investments were buying those this last spring. So that interest rate that the taxpayers wind up paying is actually less, a couple of $1 billion saved, compared to if we had gone to the traditional tax-exempt market. Mr. Chairman, I probably should have mentioned, too, just because there's comments about these things, the various investment pools, pension pools, and so on. We, in my office, the professionals manage about $60 billion in various kinds of investment pools of money, and we didn't lose a nickel in that fund in the last 3 years. We didn't buy those synthetic derivatives, et cetera, et cetera. In fact, made about $2 billion a year each of the last 3 years with that investment pool, rather than endure the losses of 20, 25% that we saw typically in other investment pools. So it's been a good record of conservative investing that paid off well.
Yeah, the important point, Mr. Chairman, is that I'm not quite sure we're tuned into the timing of the approval of what we have to do. We ran up against a wall last year, and the hope is that we don't run up against a wall this year in trying to approve whatever our budget solutions are, so that it doesn't affect our bond rating. And I appreciate the Treasurer's statement, and of course, last year the Treasurer and Controller testified before the Assembly in open session about the importance of that. And so I just want to keep our eye on it. I think that's obviously important. Thank you, Mr. Chairman.
That's right. Good point. Buchanan, followed by Mr. Arambio.
Thank you. I have a number of comments, so I'll try and make them quickly. The first, I'd like to just comment on your statement about a fundamental unfairness in terms of the rating agencies. And I'll be honest with you, I question the competence overall of the rating agencies. And I say this from a couple different perspectives. One is I could go back when I was a school board member and I was being the finance person, was the member that would actually meet with Moody's and Fitch and Standard & Poor's when we were going over our district's bond ratings. And it was always amazing to me that a school district that passed a bond that was secured through the property values and taxes of the district. And as you know, with those bonds, you determine what your payment's going to be every year, and you set the tax rate annually, could not get the highest bond rating. And it was amazing to me that corporations could. And when I take a look at what the bond ratings did during the subprime mortgage debacle, where they gave AAA ratings to subprime mortgage packages, many of which had very high percentages of mortgages that were defaulting, and then they gave AAA ratings to the credit default swaps and the collateralized debt obligations, you know, it tells me that there is not only just fundamental unfairness, but I question the fundamental competency in the work they're doing and even rating those bonds. We know that Moody's, I think just this last week, received a Wells letter. So, I mean, there's more than just people like us who are questioning what the rating agencies are doing. The Securities and Exchange Commission is questioning whether or not they're providing useful, reliable information to investors out there in general. Your comments on the trying to determine the level of activity with the credit default swaps with respect to California's bonds. You know, the high activity in the credit default swaps and the firms like Goldman that were buying the swaps and betting against mortgages they were actually selling at the same time. The reason you had the high activity was because those bond packages were valueless. And the people who were selling them knew they weren't. They knew they had a high probability of default, so they were creating these CDS as fast as they could so they could bet against them and hedge their bets. I would say that very little activity in credit default swaps with respect to California's bonds would actually be an indicator of a high credit worthiness of our bonds.
I agree.
Because that means they're not hedging against them, because the only way you make money on those is they're actually buying, as you know, buying an insurance policy. They're paying the premium on that policy with the hope that in the not so near future the policy goes, or the bonds become worthless. The mortgage payers don't pay their mortgage, and then they collect on the insurance policy. So the fact that there's no activity tells me that our bonds probably should be rated higher, because the market out there doesn't consider them to be a real risk. With the budget delays, as people in this committee know, I mean, I embrace the California Forward proposal. I believe that we owe it to the people, we owe it to local governments, school districts, and others to have a budget on time. But I also think, I mean, I look at all this stuff, and you just can't help but believe that the rating agencies, to a certain extent, are gaming the system, you know, because you've got perception there versus reality in terms of California's never defaulted on a payment. It has the second call. Our debt service has the second call on the budget after schools. I was talking with someone in finance from J.P. Morgan after we did have to issue IOUs the last time. He said, we love it. They were trading those and making money off of it. And I think your Greece versus California example, I would hope, would lead people to believe that our bonds are more desirable than bonds in other countries that have a very high percentage of debt to GDP. But finally, I think there is a bigger question here, which my colleagues have touched on, and that is, how do we want to use debt? Because we need to ask ourselves, I think, what should be financed through bonds, and what should be financed through ongoing appropriations or other mechanisms. And I ask that because typically, you know, for all of us who have had mortgages on our homes, you know, you're funding a capital project that has a long life expectancy with a payment plan that matches the life of that project. But when you look at how we've used general obligation bonds more recently, you know, as much as I believe in stem cell research, you have to ask yourself, is that the right use for general obligation bonds? You take a look at water bonds, and we've never sold a bond in the history of this state to finance water infrastructure. The Oroville Dam, which was the largest built in the history of the United States at the time, was financed through revenue bonds. The State Water Project was financed through revenue bonds. The Central Valley Project was financed through revenue bonds. And now we're looking at financing projects like that through general obligation bonds. When you look at transportation projects, we're financing not only improvements or additions, but we're financing ordinary repairs to general obligation bonds instead of funding them, through increase in gas tax or whatever, where we're tying the use. And so we're going to fund projects that we don't necessarily even have the money to maintain on an ongoing basis. So it seems to me that we have a number of questions that need to be asked. One is, how do we want to finance projects? Do we finance through GO bonds, revenue bonds, lease purchase bonds, or through other ongoing revenues? What is a reasonable percentage of the budget to commit to debt service? We know that in the 80s it was 2%, in the 90s 4%. Now it's closer to 6 to 7%, and we'll max, based on your own reports, at about 11% if we don't sell any additional bonds. And we know that we have to deal with a budget stressor like that, because that takes away money from education and other programs. And finally, I'd like you to comment on how we present bonds to the voters, because the California forward proposals will address that in terms of having to identify a revenue source. But there's a little Hoover Commission report that came out also in January of this year that recommended that at a minimum we adopt a standard table that says, these are the bonds, this is what it's going to pay for. This is how much in general fund expenditures it's going to cost over the next, 30 years, and this is how ongoing maintenance or ongoing costs will be. This is what the ongoing costs are. So if you build the bridge, you also know you have to allocate additional funds in a budget to maintain that bridge. So those are a lot of questions and comments, but
it seems to me the main point I would want to strongly agree about is, if you issue bonds, build things. Don't incur 30-year debt repayments and spend it in one. I think probably lots who supported the economic recovering bonds, including Governor Schwarzenegger, may now have wished that they hadn't done that several years ago. So that's the main thing, is just don't use bond accounts to pay for operational costs. Build things with those that are just like your home mortgage or other things you mentioned. I should have mentioned Assemblyman Nastandi has been particularly focused on whether we should engage in the congressional discussion about rating agencies, and to relate back to that discussion. Mostly, I spend a lot of time with those people. They're smart, they're interesting, they know a lot. They know a lot about California. There may be a difference between a state credit and the tens of thousands of local credits that they're responsible for perhaps having some opinion about. But I just wish they'd get their analytics done in a fairer way with respect to corporate and public. But there's a debate in Congress that's just a very small piece of the larger discussion about financial reform and all the stuff going on about the role of the Fed and whether there's a consumer product agency or not, and things that they're talking about in Washington. A very small piece of that discussion is some new federal legislation on rating agencies and how they do their analytical work. In the Dodd bill, which is the principal one in the Senate that may or may not be a bipartisan deal, it's not as rigorous in preventing rating agency discrimination as some of the proposals, including that which came out of the House Banking Committee, which in the House side simply said, don't have this discrimination in your ratings. I've been writing and urging them to adopt better rating agency language in the Senate version, which may be the bill that ultimately goes to the president, because there may not be a conference committee on this topic. It may be that some members of the committee will want to engage in that federal discussion, and I'd recommend it if you're so inclined.
It just seems to me that ratings should reflect the ability to pay.
Yes.
If I'm buying a bond that's rated AAA, that should tell me that I can expect that I will receive my payments, interest, principal over the life of that bond. And the ratings clearly, depending on whether you're going from corporate to local to the state, I'm not sure that they truly reflect that.
I agree. I know you've been generous with your time, Mr. Chairman.
Now, Mr. Rambulo was next, but Mr. Nastande, I think your question was on that topic. Or no? Okay. Okay, then Mr. Rambulo.
Thank you, Mr. Chairman. Mr. Lockyer, the Fed Reserve has been keeping interest rates at a historically low level. And I guess my question is, are interest rates going to rise, and if so, how soon? Because it seems that as interest rates rise, it's going to be even more important that we get our act together. For example, the Cal Forward or other budgetary reforms, I think are going to be even more important if and when interest rates rise. They can't go any lower, and undoubtedly, you have some insight as to what we might expect in this coming budget year and the short term.
Yeah, Assemblyman, I often wondered when I was AG and I had 4 lawyers in the room why there were 7 opinions. And it turns out the multiplier with economists is even greater. So you can find any forecast you want, and I don't claim to have any particular insight other than this consensus, to the extent that there is such, seems to be to anticipate no sharp increase in inflation and hence interest rates for some significant amount of time. The first quarter of this year, Federal Reserve statistics show was actually deflationary, the greatest amount since they've been collecting statistics. Was negative inflation, deflation for the first quarter. They do a 3-month and a 12-month forecast for their own work at the Fed. And their 12-month, they don't go further than that, their 12-month doesn't show any significant increase. Now, the Fed has purchased in various ways, about $1.7 trillion of debt in the last couple of years, about half of which is mortgages and other AIG, et cetera, et cetera. Their own debt issues. As I recall, their annual income is about $40 billion. So if federal interest rates change 0.3%, they're in the red. I don't know what that means for national policy, but I suspect what it means is they've run out of tricks. There's nothing they can do if the downturn dips again in terms of stimulus at the Fed level that will pump the economy up again as they've done in the last couple of years. Now, all of that suggests no substantial inflationary forecast. But we all know all that debt's there, and someday it's going to hit the market.
To rephrase, if I may, Mr. Chairman, to the extent that interest rates rise at some point,
yeah.
And I know no one can predict when or how much, but it seems they only have one direction to go in, up at some point. And the higher they go, the more important it would be, would it not, for the state to have a better credit rating through making some budgetary reforms.
I agree. It also suggests that you ought to maximize your sales while the interest rates are low. So if you want to build things, now's the time to try to do it to the extent that we can. And frankly, what we've been doing is selling as much as we possibly could to take advantage of these hospitable market environments. In the past, debt issuances by my office was typically under $10 billion a year. We were $34 billion last year. Now, a bunch of that is short-term borrowing, but more than half, most of it, two-thirds is GO-type issues. So we are trying to take advantage of the market, and I think that's one of the things you could conclude from the current environment. If you're going to do it at all, do it now rather than when interest rates are higher.
Thank you, Mr. Chairman.
Mr. Nastandi.
Thank you, Mr. Chairman, and I'm sorry Assemblyman Fuhrer's not here to respond, or I want to respond to his remarks about California Forward. If I understood you correctly, and please correct me if I am wrong on this, the continuous appropriation aspect makes that budget reform irrelevant, because we really can't default on our bonds because education's first, which is 40, say half the budget.
40.
And our interest payments are $7 or $8 billion a year. So $6 billion. So our revenues are now $85 billion. So even if our revenues drop to $20 billion, take half for education, you're still making your bond payments.
Correct.
So in other words, it can never happen.
There are some other things that would.
Yeah, but but if you're strictly looking at your bond payments, you would never default. So
You're right.
The reforms might be nice and good, but they're irrelevant then to the risk of default.
Right.
So, but just want to make that point to Mr.
I think
Fuhrer.
the point, if I may,
Sure.
he should speak for himself on this, but I think the point is that the stalemate contributes to reputational injury
Certainly.
and investor skepticism. I think
But
that's
not relevant to risk of default.
It shouldn't be, but
Correct.
it's still the optics
I got that.
are relevant. That's the only point.
Right, but once again, if you're purely looking at it at the math,
It does
it's irrelevant.
not. It doesn't
Right.
affect. Now, it does in the sense that if we didn't have a budget long enough, IOUs went out and other things were claiming repayment because there was debt incurred that was short term. You could theoretically wind up in an environment where the cash wasn't there to pay. This is all hypothetical and theoretical. It's not going to happen.
Well,
but,
I don't know how it could because in the
it could if you-
Constitution,
it could-
your second payment has to go to interest payments, right?
There's some question about debt repayment that are complicated legal issues, but if you had a lot of IOUs that went out because we didn't have a budget, when do you repay those IOUs and what priority do they have compared to the constitutional provisions is a legal question.
Okay.
Now, it's all hypothetical, and
I get you, but I
wouldn't
think we do
dwell
agree,
on
though.
it, but yeah.
For the most part,
Yeah.
it might be nice, but they're not going to affect or should not affect our bond rate.
I don't
Let
think
me
so.
just congratulate you. Thank you for sending your letter to Senator Dodd and the points that you'd already made. And I think it's worth highlighting also the point that you put in your letter that even though Moody's and Fitch have recalibrated their bond ratings, there's still nothing prevents them from going back to that same rating system as before. So they can recalibrate again
Correct.
and put us back on a bad spot. So I think it's very important what you did is send that letter to say put that in the bill that they must have a better system. So thank you.
I hope they will. Thanks.
Thank you, Mr. Chair.
Great. Thank you, Mr. Treasurer.
Thank you for your generous use of your time.
Very much appreciate your coming out. Now we have, I pledge to get this hearing done by 12:15. We have the other two issues. Since there's not a lot of time in the calendar, what I'd like to do is have the LAO folks come up and really just we'll do kind of a lightning round where we'll have you in game show parlance, but we'll have you make your presentations as concisely as possible, and we'll go to member questions. But unlike the very extensive conversation we had with the treasurer, I'd like to limit all of us to just quick questions, no major comments, maybe a quick comment, but really try to view this as the lightning round. So with that introduction, there's two issues on the table. We're talking about the correlation of tax expenditures and tax deductions with program spending and how that should all be considered as one, or should it be? And then the other issue is some of the specifics of previous years' issues. And we also have the Franchise Tax Board here as well. Can come up.
Thanks, Mr. Chair. Michael Cohen with the Legislative Analyst's Office, and I have my colleague James Nachmar here. I'm going to speak from my short handout that's coming around to you, and I think I can kind of touch on both of those issues as I work through the handout. On page 1, we just make the point that we've been making for months now, that we don't think the state's $20 billion budget gap can be solved on the spending side of the budget alone, meaning that we think there needs to be revenues on the table, and that the budget, in order to be balanced, will have to include some revenues. Now, when we say revenues, I just wanted to remind people that doesn't necessarily mean tax revenues. You've got a lot of different revenue options that you've used in recent years, so that can mean securitizations, the sale of state assets, fees, loans, all those kind of things. Obviously, the focus of today's hearing is on tax revenues, so that's where my comments will go. But there are other revenue sources that you should certainly talk about in your deliberations. Our three main approaches to increasing tax revenues that we're sort of presenting to you today for your consideration fall into categories of, first, delaying various tax policy implementation of things you've done over the last couple of years. The second is broadening tax bases by eliminating tax expenditures. And the third is enacting targeted tax rate increases. And so those three components are the next 3 pages of the handout. I will note 2 things before I move on. First is that there is an additional area for increasing tax revenues, and that's sort of increasing compliance and collection of those taxes already owed. Assembly Subcommittee 4 has already had 1 hearing on that topic. And so, again, I won't spend any time on that. And then the final point I just wanted to make is, as you'll recall, there is an interaction between increasing tax revenues and your minimum guarantee obligations to Proposition 98 for K-14 education. So just whenever you talk about increasing tax revenues, you immediately have an interaction on the spending side with education. And so it becomes a bit of a difficult puzzle to put together, because as you talk about revenues, your spending obligations are also going up under current law. So with that, if we could turn to page 2, where we discuss sort of delaying implementation of certain tax policies that you've adopted as part of the last couple of budgets. And this is, as you'll see the title, this is really the approach that the governor's budget took as part of the federal funds trigger. And so, if you'll recall, the governor's budget was counting on $7 billion of additional federal funds. We've told you that that's unlikely, and so the governor's budget had basically a backup plan. One piece of that was to increase revenues, and the approach he took was to delay implementation of several provisions that you've put in place the last couple of years. We think that makes sense, that these are policy changes that are recently enacted, that are ready to go into effect in the next couple years. The governor proposed generally to delay their implementation by 1 year. We're suggesting 2 years if you're going to do any of these things would make more sense. You know, in 2011-12, you're going to have all of the temporary taxes that you enacted as part of the February 2009 budget deal go away. That's about $10 billion of tax revenues. And so you might as well, if you go down this road of delaying policy implementation, you might as well go ahead and do them for 2 years to give taxpayers at least a little bit more advance notice, rather than on a year-to-year basis simply pushing things back more and more. So in general, these delays, the biggest one you'll see is a moratorium on the use of net operating losses. This is a technique that the legislature's used over a number of budget problems to basically stop businesses from evening out their profits and losses for a short amount of time. Reducing the dependent credit, which is something we've actually recommended doing on a permanent basis. Just to go back to the pre-1997 policy of tying it to the personal credit. In terms of the single sales factor, the policy that you put in place basically gives businesses the option of choosing whether to stick with the current system or move to a single sales factor, and this is all dealing with how you apportion your profits. We'll have a more detailed report for you in the next couple of weeks, but our approach is that we think the single sales factor, moving that direction, makes some sense. Here we're suggesting delaying it a little bit, but to make it mandatory that the choice about which way you allocate your profits is really causes some tax policy problems. So that's kind of one framework that you can look at, basically going back to the 2008-9 and 2009-10 Budget Act, and think about whether you want the policies that are going to start costing you revenues in the upcoming year to go into effect. Turning the page to page 3, we get into tax expenditures. And again, for those of you new to the tax world, tax expenditures are basically those credits, exemptions, deductions, and so forth that are part of the tax code that basically, if they weren't there, you would end up with more revenues. So in essence, we've always treated tax expenditures as a type of program, just like you have a program on the spending side of the budget. And so, except unlike the spending side of the budget where you're enacting a budget every year that in essence is appropriating money for these programs, tax expenditures don't generally have that same review. And so that's why we've periodically tried to go through these various programs, look at whether or not we think they're achieving their original goals and whether or not we think those original goals are still valid. I'm not going to, given the time limitations, run through all of these. Just to point out the first one on the list, it gives you a good example of how we think about the Enterprise Zone program, where you basically are running a program through the tax code to create tax incentives. Yet the vast majority of the research out there indicates that you're not really generating any new economic development as the program was designed. Instead, you're simply moving it from one area of a region to another, and that's the reason we're suggesting eliminating that one. This is just sort of our current best list that where we think you should focus your attention. You have lots and lots of tax expenditures in the code. We've done plenty of work on these in the past, but certainly there's more that you and your staff could explore. Finally, on page 4, we turn to targeted rate increases. So unlike the tax expenditures where it's sort of a piece of the tax code, here looking at a couple of specific taxes where we think on tax policy grounds you can justify raising the rate. You'll recall Mac, when he's spoken to you previously, has suggested staying away from further rate increases on the big 3, the personal income tax, the corporate tax, and the sales tax. You already have increases in those areas in place for 2010-11. Here's 2 areas that if you're interested in raising rates, we think they can be justified. First one is the alcohol tax. Those rates haven't been adjusted for inflation since 1991. And so we think, given that their societal costs from drinking, you can make a reasonable case that that those rates should be increased for inflation. It's about 60% an increase, and obviously you could phase that in over several years if you wanted to do that. The other tax rate we wanted to highlight for you today is the vehicle license fee. Again, this is one that you have increased on a temporary basis for 2009-10 and 2010-11. We think there's a tax policy case on an ongoing basis to set the rate slightly lower than where it is now and set it equal to the property tax rate for all other property in the state, which is just over 1% when you include the debt issuances that people have authorized at the local level. Vehicles are obviously a type of property, and so setting the tax rate at the same rate as the local property tax makes sense to us, that you basically would be taxing all property in a similar way. So with that, obviously, I just covered a lot of ground, but I'll happy to take any questions.
Appreciate the depth and the speed. I was going to go through all the panelists. Is there something specific?
No, I was just going to, for the chair consideration, I think it's a very important topic, and I would hope that we could schedule some time to have a more lengthy discussion, because this is about revenue, and I think that I just would like more time.
I appreciate that and agree with that, and we will look for that. The reason why I'm even going ahead with the lightning round now is just because I don't want to lose this little opportunity, but this does no way preclude us from having a further discussion, and I would welcome that.
Save my questions.
Yeah, Mr. Nachbauer, did you want to add to that? Okay, then we'll move to the FTB, Mr. Joseph and Mr. Putler.
Hi, good afternoon. My name is Carl Joseph. I'm an assistant chief counsel at the FTB in charge of the Multi-State Tax Bureau. The three items that were on the agenda for us to discuss today were to get an explanation about the single sales factor, a piece about NOL carrybacks, and then the credit sharing provision that was put into law. First, on the single sales factor, essentially what we have here is a rule of apportionment. When an enterprise, business enterprise, makes its income, you can think of that income as sort of like a pizza pie. And then the apportionment method is the method by which the state decides its slice of the pie. Well, historically, we've done that by use of a three-factor formula looking at the payroll, property, and sales of the business enterprise in California as compared to those three items everywhere. What that effectively does is it means that as your property and payroll in the state gets higher as a percentage, the size of the pizza pie gets bigger. And to some folks, this is seen as a detriment to a business expansion in the state. In other words, the more property and payroll you have in the state, the higher your portion slice to California becomes. And in order to sort of counteract that, we keep moving away from that to make the sales factor more and more of the method to determine that slice of the pie. What the legislature did was we now have an election to use just sales only. And this is positive for in-state taxpayers in that it will lower their apportioned slice to California by no longer looking to their payroll and property and just looking at their market exploitation. Now, for out-of-state taxpayers, normally this would perhaps increase their slice of the pie because they're in the California marketplace, but they are based outside, and so their payroll and property are not here. Well, rather than having everybody on one system, we did it as an election. So now the out-of-state taxpayers still can get the effect of having their out-of-state payroll and property, and therefore their slice of the pie for California tax being small, while the in-state companies get the benefit of this sales factor only method, which decreases their taxes as well. Now, the unfortunate part about this, or at least the thing that's a little bit interesting, is with out-of-state companies in the current system with the election, as they increase their expenditures on payroll and property outside of California, they continue to decrease their slice of the California pie. In essence, they almost have an incentive to keep investing outside of the state because they can still utilize payroll and property in their apportionment. If we were on a mandatory system where everybody was just sales, that determination would then become neutral. So we have that sales factor only method that's now available for years 11 and forward, and it's going to be a simple calculation for taxpayers. When they look at their payroll and property and the average of that is lower than sales, then they'll not elect to use sales. If the sales factor is less than their payroll and property, they will, and simple as that. The second piece, the NOL carryback piece that came in, effectively, as part of the tax code, for a very long time, we've recognized that there's a business cycle, and in order to get a better sense of the economic gains for business enterprises, we look to more than one period in order to get a real sense of whether they've earned money or not. And the way this has been accomplished in California primarily has been through carry forwards of net operating losses. You can take your loss from this year and offset it against your income from the next year. In the last budget cycle, we got ourselves an NOL carryback provision. Now, what this does is it allows taxpayers to take their loss from this year and carry it back to a prior year when they paid tax in California and get a refund, get their money back. Some economists see this as a form of stimulus because you have taxpayers that are in a loss position this year that are hurting, and by giving them some of that money back, you may well be helping them to keep their employees or to keep their business running. The downside is that the business cycle doesn't just affect taxpayers, of course, it affects the state as well. So you get in a situation where not only is this individual companies hurting, the state's hurting as well, and now you're giving them back cash payments from the prior year, so there's money going out, rather than having the effect of the NOL recognized in later years, like on a carry forward. When these two items are put together, the election and the carry back provision, you end up with something that can be a little bit kind of a tax planning opportunity, in that you choose your size of your slice of the California pie to be as small as possible in a gain year, because you don't want to pay tax on the gains. But when it's a loss year, you make it as large as possible. You choose the method that results in the largest amount assigned to California, thereby generating the largest NOL, and then you take that NOL and carry it back to the year when you had that smaller slice of the pie, therefore making your NOL years far more powerful in the sense of being able to offset more income in prior years because you've elected back and forth on these methods. So that is one item in the election that is somewhat problematic. NOLs are a recognition of a business cycle where business goes up and down. The election is not a recognition of a business cycle. It's simply done on a yearly basis, and so you can, within the business cycle, make determinations that will basically maximize the benefits of the election. The final piece was the credit sharing piece that came in. What that does is that when you're, for instance, if you're a single corporation and you do everything in one corporation, you have all your income in there and all your credible activities in there, you're not going to have a problem. You'll have your income, your tax, and then you'll be able to take your credits against it. Well, California, we look at business enterprises for income purposes as either one corporation or a group. Well, if you do it as a group, you can end up with a situation where income is being assigned to each individual entity in that group, but not all the entities in that group will have engaged in the creditable activity. When that occurs, you can have entities that have significant credits, but not a lot of income, which results in tax that then they can use those credits, while other entities in the group may well have lots of income assigned to them, but they didn't engage in the creditable activity. So while by giving them this credit sharing provision, what we've done is we've allowed the income of the entities that didn't engage in the creditable activity to take advantage of the credits that are otherwise trapped, some people would say, in the entities that don't have a lot of income assigned to them. So the benefit there is, of course, more efficient use of the credits on a group basis. The sort of cost of that is you're going to have entities that did not engage in any creditable activity that are getting immediate benefits from taking those tax credits that were earned by other members of their groups. That provision now is in place. I believe it can begin offsetting in the 2010 tax year. Those are the three items that were on the agenda today.
Butler, do you wish to add?
Nothing to add.
Okay, and again, I apologize to members for we did not schedule enough time for this. We're going to break in just a few minutes, but if members want to make quick comments, I'm open to that. Does anyone want to add? Go ahead, Mr. Swanson.
Chairman, just and the reason why I agree, I think we deserve more time, because I'd like to examine the LAO's early assertion that we have to examine this question of revenue, because I assume that means that we're running up against fewer and fewer places to actually cut to operate a state. But I mean, that deserves some discussion, and I think that the options deserve a full committee hearing and discussion. Revenue, I think, are an important part of the budget solution if we're going to also have priorities like education and some other matters. So I endorse us having a longer session discussion.
Yeah, and maybe one specifically on revenues.
On revenues, yes.
As opposed to what we're hearing. Mr. Nastande.
Thank you, Mr. Chair. And I agree. Well, I guess your opinion I would like to hear is dropping the corporate rate, which is now I think 8.8%, to say 3%. Attempt to eliminate deductions and just do a flatter, less deduction-based corporate tax. Second of all, from the LAO, maybe. I think the problem is our revenues dropped from roughly 105 to 85 in the last year and a half. Have we adjusted our spending to to that reality? Or are we still operating on our programmatic level at that $105 billion? I mean, have we actually drawn down programs and long-term spending, or is that part of the problem where we're just trying to fight back this $105 billion revenue that's not coming back for at least a few years? And so have we drawn down sufficiently to meet that?
Sure. On the first part, in terms of lowering the rate and getting rid of more of the tax expenditures, we haven't looked at the specific percentage, but that's kind of always been our philosophy in terms of tax policy, that to the extent you can, you look at these tax expenditures and get rid of them in order to lower your overall rates. Obviously, in the terms of a budget shortfall year, the tenor of the conversation changes a little bit in that you're trying to balance your budget. But we've suggested eliminating a lot of these tax expenditures, in the best of times. And in those times, obviously, we'd head towards lowering.
Yeah, 'cause I don't think you can have to happen at the same time.
Absolutely, and that it's unfortunate that in this type of budget environment, you are mixing all sorts of policy conversations that in an ideal situation you would be able to have separately. In terms of your second question, in terms of the level of programmatic spending, it's certainly the case in a lot of areas, particularly those areas where we had federal stimulus funds that, in essence, were running the program at the higher level, and it's just on the short-term basis, the federal government is paying a greater share of the costs. We've also gone down that road to some extent when we've deferred costs, so that in Proposition 98 is a great example where we've made some ongoing cuts there, but what we've also done is simply deferred expenses from one year into the next, expecting that we basically can maintain the program level. So I think at some point, at this point, we're somewhere between the $102 billion level that we were at several years ago and the $85 billion or so that you mentioned in terms of programmatic spending. We certainly have made some real program reductions, but that we in no way have adjusted our overall.
A lot of times those are temporary reductions. That was my point. I don't think we adjust our infrastructure, our bureaucracy, and so forth to bring down that lower level. It's just a simple one-time cut, and the assumption is next year you're going to come back and fix that one-time cut. Without accepting reality that revenue is not coming back.
Right. No, and that's been one of the points we've been trying to make this year, that we do think that, obviously there's the outside chance of a nice economic bounce back, but the consensus economic view is that we're not going to get back to that level anytime soon. And we do think the state needs to basically take a hard look at its priorities, but so we've been giving you recommendations on the spending side to basically restructure or eliminate or reduce services for programs, and we think basically that you should have the same treatment on the revenue side, but definitely the economic situation we're in requires kind of a rethinking of priorities for the state budget.
Right. And presumably also you have to look at the rate of contraction on certain programs and whether that has deleterious effects on the economy as well, as you factor it all in terms of what is the right level to end up at.
Sure. So we've certainly, it's an issue that your committee has raised at the hearing, and it's certainly something we're doing our best to take into account.
Great. Well, thank you very much. We're going to look for a time where we can get you guys back here and have a more of a thorough discussion. We appreciate you being here, and this meeting is now adjourned.